the final session for the conference, and as Mike said, we're saving the best for last, which are the diamonds. Perfect for the holiday season, Matt. So we're going to start the session with Stornoway, Matt Manson, CEO of Stornoway. Matt has over 17 years of experience in diamond exploration, development, and production. Prior to working at Stornoway, Matt worked with Diamond Corporation in various roles. So I'm going to welcome Matt to come up and start.
Thanks, Tanya. Good afternoon, everyone. So this is a story of what will be Quebec's first diamond mine. Here is Stornoway in a snapshot. 100% ownership in Renard. We like to think of it as the world's most advanced new diamond project under development. That basically means that permits are right in front of us. That's going to be the next major milestone for us. And we're on track for construction startup in 2013, following a new agreement in the last couple of weeks with the Quebec government on our access road, which I'll cover in this presentation. And Renard, we believe, is very strong base case economics. The aspect of it that's truly different, truly world-class, is the upside going down, and I'll talk about that as a central part of this presentation. The road's going ahead, permitting near completion, and I'm sure you heard two very good talks on Tuesday from De Beers and Harry Wilson on the fundamentals of the diamond business. It needs no repeating by me. Despite a soft 4 months here in the diamond sector, the long-term fundamentals remain very robust. It probably is, of all the main commodities, it's probably the item that has the most severe long-term supply and demand shortfall. We're hearing reports of likely De Beers supply shortfall in 2013. So some of the supply crunch is right on top of us perhaps here. So positive about the future. But that's so much as I'll say about diamonds, other than our own diamonds. So a market cap of $100 million. It was $250 million about 18 months ago. This is a sector that's been compressed like many others. So I like to think we're the least expensive diamond stock to be buying right now. 6 analysts, 5 buy, 1 market perform. There's about $30 million in the bank as of our most recent quarter end, October 31st, which we haven't published yet. But so a healthy cash balance. We are spending that money, of course, to develop this project. Investis from Quebec is our biggest shareholder on a 34% basis, fully diluted, 25% of the voting shares. Agnico Eagle, in the case of the Pro, is a large institution, and quite a healthy and increasingly liquid float of about 50%. So I'll remind you where Renard is. It was discovered in 2001. It's surrounded by the roads and power lines of the Hydro-Quebec network, so it's in the middle of regional infrastructure in northern Quebec, and that dashed line is the road that's getting built to provide us all-season road access to that highway network. 9 kimberlite pipes and a family of kimberlite dikes. Everything is diamondiferous. We think 5 of those ore bodies are economic to be mined immediately. 3 are in the reserve, 2 are in the inferred resource, with an additional pipe, Renard 1, that we believe has the potential to come into the resource subsequently. So here's our most recent information. On October 26th, we were informed by the Quebec government that they would conduct a budget review of the ongoing infrastructure project called the Route 167 extension. This was a 240-kilometre long road. It was a central plank for the previous Quebec government's Plan Nord. It was trending over budget and behind schedule. The new government decided to undertake a budget review. They told us on the 26th of October. We released that to the market on the 29th. The implication of that to us was a delay in our project. Within 2 weeks, we had a new deal that we put out on November 15th. And that new deal was that we will take over construction of the second half of the road, the last 97 kilometres, segments C and D. The government will finish off A and B as a 2-lane highway as planned. By March, we'll be driving up to the site as a winter road to mobilize construction equipment, and then by April, we will be building the second part of the road as a single-lane mining-grade road. Quebec is financing us to do this with a total financing facility in 2 portions of up to $85 million. And this will be repayable by us at a 3.3% interest rate, amortized over 15 years upon startup of commercial production. So it's a win-win situation. Quebec gets the road built, the communities see it built, we stay on schedule. This allows us to maintain vehicle access within 2013. We're avoiding the longer schedule delays that we were facing previously. And as of that deal on November 15th, we're essentially in construction. The project parameters, this is based upon our November 2011 feasibility study. The resource is 24 million carats in the green in the 5 ore bodies in the mine plan, 17 million carats in the inferred resources, another 24 to 49 million carats in the exploration upside. So that's the material that can reasonably imply is there below the inferred, and that's supported by some drilling. So 65 to 80 million carats down to 700 meters. It's one of the biggest undeveloped inventories of diamonds in the world, and each of those ore bodies is open at 700 meters. Based on the green only, the feasibility numbers are shown there: 800 million capex, $2.7 billion of cash flow over an 11-year initial mine life, $280 million after-tax NPV, and a 15% after-tax IRR. Of significance is what you get when you put the inferred resources into that mine plan. We are permitting and financing and building a mine that's capable of taking all of the rock out on that slide. And if you put the inferred resources in, you get a very accretive result. We are restricted under the new 43-101 guidelines to tell you what the economics of an inferred resource are after we've disclosed the feasibility study, but that's the mine we're building. We're building a 20-year mine, and we're financing a 20-year mine, and we're doing it off the first 11 years of reserve life. Now, let's focus on this aspect of Renard that is different and is truly exceptional, and it's the resource upside going down. And there's a before and after story here. This is what we thought Renard was in 2008. We thought it was relatively modest. Our 2 principal ore bodies, 2 and 3, were classic carrot shape. We know these are transitional kimberlites, and that's important because that guides our approach towards the grade and the resource determination. But a lot of work has gone in here. I mean, you see the inventory of data that's gone into establishing the resource, 88,000 meters of drilling, thousands of tons of DMS processing, hundreds of tons of microdiamond work, $140 million of sunk costs in 2001. The seminal moment in this project was 2009 when we drilled these ore bodies at depth, and we discovered this. That's actually what the ore bodies look like. In 2009, we tripled the size of the resource with 1 season's drilling. That was up to $3 million of Quebec super flow-through spending. The grades are going up at depth in Renard 2. 181 CPHT in this brown unit, 83 CPHT in the blue unit, and more of the brown as you go down. So this is an ore body that gets bigger and higher grade as you go down, and that's what's special about Renard. And if that's an odd shape for a kimberlite, well, that's because that is the actual shape of the kimberlite. The kimberlite is cloaked with 2 units called cracked country rock and country rock breccia. These represent the eruptive halo or the envelope of the eruptive event within which we have the ore. So there's your classic carrot-shaped kimberlite, and that's why Renard 2 apparently is bigger at depth and at the surface is contained within this envelope of eruptive material. Another way of sort of indicating and communicating the upside here is you take all of that ore. We think it's all economic. You graph it up there. That's millions of tons. We're going to mine this at 2 million tons a year. So there's our 11-year mine life and the feasibility. That's what we're using to finance the mine infrastructure. Add on the inferred, that gives you over 50 million tons, 20-year mine life. If the upside comes through in the 700, we're talking about a 30 or 40-year mine life, and it's open below that. So that's the exceptional aspect of this project. The vision here is something that will last that long. That's why Quebec is financing a road to open us up and tie us to the Quebec highway network. It's the vision of multiple generations of local people working at this project. We are somewhat restricted in what we can do to make that reserve grow because most of the upside material is at depth, and in the diamond project that requires drilling and sampling, and that's a technically challenging thing with the diamond project. But we can get in at the surface of Renard 6.5. It's our lower grade ore body. It's about 30 carats per 100 tons, but it has recovered some nice big diamonds in the past. There were 4 carat stones sitting in drill core. We took a 5,000 ton sample this summer. Given the grade at that particular site, we expect to recover about 1,000 carats, and that should be enough to allow the conversion of R 6.5 to indicate a resource and then hopefully to a reserve. It represents expansion ore for us. We can hopefully move our production rate from 6,000 to 7,000 tons a day. And of course, we're already costing a pit in that area within our feasibility study. Renard 65 represents a borrow pit for waste for the underground mine, and so the cost of developing that, of stripping that ore out, is already contained within our economics, but the ore, being inferred resource, has to be stockpiled, so it will be accretive if we can convert it to reserve and get it into the mine plan, which we expect to be able to do in the new year. Here is the feasibility mine plan, and I caution you that this is subject to an optimization study, so this is changing a little bit right now. There you see open pits in Renard 2, a shaft and a ramp, blast hole shrink stoppage for the underground mining method. Most of the capex is in the spaghetti there in the underground mine. What became immediately obvious after we got the feasibility out was we didn't really need the shaft and the ramp. It was too much. So the optimization study, which is ongoing right now, is looking to bring the shaft out. We'll beef up the ramp, and that should bring the upfront capex in the project down. This is an optimization study that we hope to bring out to the market shortly, and we should be able to achieve that whilst maintaining the same production rate. There will be just some fine-tuning to the underground mining method and the production schedule, and some other aspects of the project are going to change. Some of the headline numbers in this project are going to change when this optimization study comes out, but we expect this will be a positive result. Here is the arrangement. Open pits, a dry stack with the tailings. We're not leaching metals or acid off that tailings, so we can avoid any impact on fish habitats. That allows the permitting to go very smoothly. Very modest environmental impact. It's a project that's garnered a lot of public support. Our social license is very strong. We've seen no particular challenges and problems here as we've gone through the public consultation process with the permit. The diamonds are very nice. It's a coarse distribution, a white to brown color profile. We have a 1% bort, which is unusually low, which is why our average price of $182 per carat is higher than the world average. That was from May 2011. We don't feel the need to refresh that price estimate right now. That was before the big run-up in prices in 2011, and the prices have subsequently come down again since. But we do expect to be freshening that price in the new year in the context of our project financing strategy. And the production schedule, again, this is subject to change after the optimization study. But achieving upwards of 2 million carats per year in the feasibility production schedule, and revenues of between $300 and $500 million, EBITDA is about 200, 250. So this is a large project, and this is the 11-year feasibility case. When you put the inferred resources on, this plateau at the top of the production curve gets pushed out as you go deeper on the inferred resources in Renard 2. So we regard this ultimately will be a 2 million carat a year producer, and that's what it will be known as in the world market. And on that basis, and of course this is sometimes a surprise to people because people still think of Renard as what it was in 2008 before that drill program. But at 2 million carats a year at $180 a carat, that's $380 million a year. And if you put Stornoway on that basis up against 2011 production data, where De Beers and Alrosa, the Russian producers, were at the very top, Stornoway comes in at number 5. Now, of course, appearing on that graph will be Bukhara and Manson province, because it will follow me. What I'm doing here is putting Stornoway up against the existing mine production numbers that were public as of last year. But the message here is that Stornoway is heading towards being the 5th largest producer in the world. So Renard is not a small project. And of course, DHP and Rio Tinto are leaving this business, and those projects are declining probably also. So this is a significant producer in the world rough market in the future. Development schedule. This is the feasibility schedule that had first vehicle access in July 2013, and that allowed construction to begin for 24 months, and then production middle of 15, commercial production by 1st of January 2016. The new road deal pushes out that schedule driver to the 4th quarter of 13. So we're probably going to take a 4 or 5 month delay on that particular milestone. And then our optimization study will give guidance on where we expect now the construction and the production schedule will fall out from that. We're taking a 4 or 5 month delay here, but we think that's quite manageable. We've had 12 months of milestones in this project. We've had successful public hearings. We finalized our IBA with the Crees, the impacted Aboriginal group, in March. We've signed partnership agreements with local communities. We've started our pre-development work. We had our mining license issued in October. We're expecting our principal regulatory approval, the certificate of authorization, very shortly. That'll be the next major milestone. At that stage, we can essentially say we're permitted. And we financed debt and equity in the spring to fund the pre-development work. And we announced that we were working on a $475 million project debt deal in September with 7 commercial lenders, including Scotiabank, I'll add. So this is going well. Progressive achievements on permitting and financing and pre-development over the last 12 months. So what to expect? You're going to see the completion of the project permitting shortly. You're going to see capital cost optimization with the optimization study shortly. You're hopefully going to see reserve growth through R65, and you're going to see guidance and progress on project financing. Our project financing mantra is minimum capital, minimum equity. We want to leverage as much as possible. The current market demands that. We also want to bring that financing challenge down through the optimization study, and that mantra is guiding our progress. And the investment imperative for Stornoway is this. This is the type curve for the Lassonde cycle. This is Aber, a company I know very well, between 95 and 2007. And if you want an example of the Lassonde cycle, it's this. There was the run-up in the value of Aber as the resource was growing at Diavik. And that resource stopped growing at about 97 after the bulk sample was complete. And then you get the classic decay in value through the feasibility stages where all the ugliness of time and cost begins to be built into the story. That vertical line right there was the sell-off in the Aber stock in July 1990 when the feasibility came out. I was in the office that day and the stock went from $15 to $7 in one afternoon. The low point was 6 months after that, and then the run-up in the stock was the classic de-risking moment when milestones are achieved, permits arrive, an offtake agreement was signed, financing tranches are released to the market, and you're getting closer to the moment of cash flow and the value of the assets increasing. It's the perfect example of this, and between the bottom and the top was a 4 times return. Sorry, the fonts have gone screwy here on the presentation. So you put Stornoway on that graph on the same scale, anchor it by the date of the feasibility coming out. There's our sell-off when the feasibility came out. We're 12 months after that, and we hit our low point, I hope, a few weeks ago. Same scale, horizontally and vertically. And to achieve the result that Aber achieved is our objective. And to do that, you need 3 things. You need the asset, the underlying asset has to deserve that reward. I believe Renard does. If you take it to the top of the valuation curve, first day of commercial production, with the inferred resources converted, because you're down there at that stage to convert them, with the capex spend and the cash flow in front of you, you can see a couple of $2 billion of value. You need milestones to be achieved, second thing, and we're achieving those. We're getting the permits, roads are getting built, financing is progressing, so the project is being de-risked, we're moving it towards cash flow. The third thing you need is a market that rewards that asset being developed on those milestones. That's what we need in 2013, and if you subscribe to the view that a better market that rewards fundamental value mining assets is coming next year, then Stornoway is an investment imperative. And I will leave it at that. Thanks very much. Tanya.
Are there any questions for Matt? Matt, maybe I can just ask one question then. Just how much was the shaft within the capex of the original feasibility study?
It was about $125 million. And of course, you don't save all of that by taking it out because we've got to beef up the ramp, put in more ventilation, have a larger truck fleet. We expect to save a large chunk of that $120 million. And since that's all upfront capital, we expect that to be impactful on the economics of the project.
Perfect. And then just, you were at Aber when you did the offtake agreement with Tiffany. Is that something you were thinking on in terms of financing here with some of the jewelers and or other?
Yeah, I think we've been very clear that if there's a deal to be done where we can monetize future diamond supply, and that is accretive in terms of our NAV per share, we'll do it. We're completely non-dogmatic about that. If we recognize that the principal challenge left for us, the asset's good, the road's going ahead, schedule is locked in, principal challenge now is the financing. If there's a deal there to be done, and I think there might be, then we'll certainly look at that and do it. And again, the principle, the mantra here is minimum capital, minimum equity. So if we can do that financing on a minimum equity basis, we'll certainly go that way.
Perfect. If there are no further questions, then I'm going to thank Matt for his insights.